But there will be other crises. There's no way of knowing when you're in a situation like we were in the fall of 2000.
Have you ever wondered how successful investors like Warren Buffett approach financial crises? Join me in this engaging video to discover his insights on navigating uncertainty in finance. Learn from Buffett's wisdom and gain confidence in your investment strategy, knowing there will always be challenges ahead. Let's jump right in. According to the Motley Fool, back in 2008, at the height of the Great Recession, Buffett wrote an opinion piece for the New York Times with his thoughts on the future of the market. Fear is now widespread, gripping even seasoned investors, he writes. But fears regarding the long-term prosperity of the nation's many sound companies make no sense. These businesses will indeed suffer earnings hiccups, as they always have. But most major companies will be setting new profit records 5, 10, and 20 years from now. Indeed, that prediction proved accurate as the S&P 500 index proceeded to break records and enjoy one of the longest periods of sustained growth in its history from 2009 to 2020.
People today, 10 years later, they're still affected by the crisis, various people in different ways, but they're not as affected as they were in 2009 or 2010.
Warren Buffett's insights into the aftermath of the 2008 financial crisis emphasize that the upcoming recession might be worse. He's not making a direct prediction, but he points out that the 2008 crisis left deep scars, and people are still struggling even after a decade. When he says people are not as effective, he means they haven't fully recovered. This hints that the road to recovery from the upcoming recession could be even tougher, potentially making it worse than 2008. Buffett also mentions a lack of accountability for those who profited from the previous crisis. This raises concerns that the problems that caused the 2008 crisis are still around. If these issues aren't fixed, it could make the upcoming recession more severe. While Buffett doesn't say outright that the upcoming recession will be worse than 2008, his words suggest it could be. The long-lasting effects of the 2008 crisis and the unresolved problems point to a challenging economic future. This connects well with whether the upcoming recession will be worse than 2008. Now listen to Warren Buffett's one-minute analogy of the U.S. economy.
You can imagine the American economy as an economic train moving down a track that has no ending. And it picks up cargo and passengers as we go along. There's 330 million of us now, and there were only 4 million in 1790. And our farms are incredibly more productive, and we have 75 million houses, and we had a few huts then, and we have great universities and all of these things. So we're just constantly moving more and more cargo and passengers along, and occasionally that train is going to get derailed.
Warren Buffett's analogy of the U.S. economy as an unstoppable train illustrates its growth. He warns that economic setbacks like the 2008 real estate bubble burst demand financial readiness and vigilance. In 2008, Wall Street faced its worst day since 1983, notably impacting the Nasdaq. The fallout extended globally. From 2006 to 2012, the U.S. grappled with a severe housing decline, leading to a worldwide recession. This period, often called the bubble era, preceded the crash but received less attention. The bubble era saw steady and skyrocketing home prices, akin to a modern gold rush. The current housing market shows parallels. After the 2012 crash, prices rose gradually, then surged in 2020. While most people recognize that the current housing market is far from normal and seems to be in the final speculative stage, marked by investment and greed, what often remains unmentioned is that before the last housing market crash, numerous individuals warned of the impending catastrophe. The foresight of the crisis wasn't limited to just one person. Many prominent investors and even ordinary individuals were acutely aware that the market was inflating into a massive bubble, poised for a devastating collapse. Back in 2006, near the height of the previous housing bubble, Warren Buffett, was questioned about the state of residential real estate and whether he thought it was in a bubble. His response then bears a striking resemblance to the current situation unfolding across the United States. Warren Buffett's answer centered on a critical issue: investors turning the real estate market into what can only be likened to the penny stock market, characterized by excessive leverage, speculation, and avarice. He correctly predicted that this deadly combination would inevitably lead to a market implosion. He emphasized that regular homeowners were not to blame. Speculative real estate investors were primarily responsible for the market's dangerous trajectory. Warren Buffett highlighted that the real estate market operated on a different set of dynamics than the stock market. Stocks trade on live markets, where prices are updated continuously during trading hours. In contrast, real estate transactions are based on comparables, often derived from a limited number of transactions. This inherent limitation in real estate valuation makes it prone to significant price swings, as a few bad sales can swiftly reprice an entire neighborhood. This is why real estate crashes can happen suddenly and without much warning. Moreover, Warren Buffett illuminated the idea of the vital few. He explained that it doesn't take many buyers to determine prices in real estate, and there's a common belief that there's always someone willing to pay more. If just one buyer is willing to pay a high price, it can temporarily boost property values throughout a neighborhood. However, suppose news spreads about a declining market. In that case, the opposite can happen quickly, causing prices to plummet as investors rush to sell. This is precisely what occurred in numerous markets during the 2008 housing crisis. Warren Buffett's insights also apply to lending practices. He emphasized that irresponsible lending often results in disastrous consequences, typically on a large scale. Irresponsible lending may not immediately show its negative effects, creating a delayed wave of financial trouble. It's similar to an illness that takes time to display symptoms, but spreads rapidly once it does. While rooted in the past, Buffett's observations about the 2008 housing crisis are remarkably relevant to the current housing market. He and his colleague Charlie Munger noted a parallel between the reckless lending that fueled the manufactured housing bubble years ago and the questionable lending practices currently supporting the stick-built housing market. This situation creates a sense of déjà vu, where risky loans are offered to speculative investors, potentially setting the stage for another market collapse.
I'd always believed that you do need somebody who can say, we'll do whatever it takes. The U.S. government had to do the right things, not perfect things, but generally the right things, starting in September, and they did a fantastic job, actually, of getting the train back on the tracks. There was still damage for a long period thereafter, but it was really important to have fast action at that time. And we were very fortunate we had the leaders we did. If we'd had people who waited for all the information to be right, or for committees to work, or that sort of thing, it would have been far, far worse.
Warren Buffett emphasizes the importance of having leaders who can quickly make the right decisions, even if they aren't perfect, but generally right. The reference to the U.S. government's response in September demonstrates the importance of swift and effective action in times of crisis. Buffett acknowledges that while there was some ongoing damage, the rapid response played a vital role in lessening the impact. He credits the leaders for their proactive approach. He suggests that waiting for perfect information or getting bogged down in bureaucratic processes would have resulted in worse outcomes. This insight reaffirms the significance of timely and pragmatic decision-making in maintaining the stability and progress of the American economy. Warren Buffett's insights about the 2008 housing crisis are a stark reminder of the risks inherent in speculative real estate investing, particularly when driven by excessive leverage and greed. His warnings about dumb lending practices and the potential for delayed but severe consequences should serve as cautionary tales for those witnessing the current housing market's dynamics. The critical takeaway is that history does not repeat itself precisely, but often exhibits similar patterns. The current housing market may not be a replica of the past, but the underlying dynamics bear a striking resemblance. Investors and homeowners alike would be wise to heed Warren Buffett's warnings, as they provide valuable guidance for navigating the complexities and risks of the real estate market. The lessons from the 2008 housing crisis underscore the importance of responsible lending, vigilant risk assessment, and a cautious approach to speculative real estate investments. As the housing market continues to evolve, these lessons are a timeless reminder that informed decision-making and prudence can be the keys to preserving financial stability in the face of market volatility. While the future remains uncertain, Buffett's wisdom reminds you that crises are inevitable in finance. However, they also underscore the resilience of the American economy and the importance of swift, decisive action by both leaders and individuals. As you face the uncertainty of what lies ahead, it's crucial to remain informed, proactive, and prepared for whatever challenges may come your way. What do you think about this topic? Let me know in the comments section below. Don't forget to like, share, and subscribe to Finance Soon channel. I'll see you in the next video.